Sanjay Dutt joins us now. Sanjay, good morning. Thank you for joining us. Sanjay, I hate to start with the question on Vodafone, but it's a stock where I look at your Twitter handle. You do have a view.
Yeah, Nikunj, I do have a view, and I feel if the telecom sector is going to do well, and the fact that Vodafone-Idea is going to survive now, we were all talking about the company shutting down and moving towards a duopoly. You need to get your entry levels correct, and I think this would be a good investment for the next 2 to 3 years. I don't see any reason with the company still having a 30% of active users trading at a substantial discount to enterprise value of what the other two players are trading. Yes, it's going to be a volatile, risky bet. We've already seen so much of volatility over the last 15, 20 days. But I think the major point here is the uncertainty is out of the way with regard to AGR dues, with regard to anything else that was plaguing the company and the sector. So in that sense, I have a positive view on the stock and the sector. Of course, I am invested in it.
Sanjay, before I get into specifics of what else you like, I just want to understand first your take on the market. Now, in March, markets were bombed out and the economy and valuations were looking very attractive, which is that gold was available at the price of silver. Now markets are no longer oversold, but investing, you have to buy gold at the price of silver. So after the recent run-up, where in the markets right now gold is still available at the price of silver?
See, because what you need to watch right now is the EM trade on the dollar, because that's what is driving flows and that's what is driving EMs right now. If we see a reversal in the sense the dollar starts to strengthen and the EM trade pauses, I think we'll see the markets coming off, and accordingly we will see the gold and silver prices also adjusting. So it's the whole game right now is all about the dollar and the EM trade linked to it. So that's where you need to keep an eye on. And as soon as you see the rupee weakening or the dollar strengthening from the current levels, I think you need to be cautious on the EM trade, because we would be then set in for a reasonably good correction, or maybe if not a correction, at least a consolidation phase with a downward bias. This is what I forecast for at least the month of September, October.
We seem to be hearing, Sanjay, that that perhaps it's best to stick with the so-called defensives, or perhaps not even from a defensive angle, but clearly just in terms of where we've seen the maximum interest. For instance, in pharma, despite the run-up, that continues to be the preferred play and perhaps a safer play while we see how things unfold in September, October. Would you agree? Pharma followed by an IT, perhaps?
Pharma, no doubt, is a good secular story for India. Good pharmaceutical companies should be bought in a correction. But we must understand, if we go into a consolidation correction phase, everything comes off 5, 10% or 20%. And you do get good entry points when the very short-term trade unwinds. So therefore, you need to be careful. Even the best of names in a sector like pharmaceutical, which is positive for the next few years, you would get 10 to 20% lower in your favorite stocks, which you identified. So the whole idea is positioning yourself right now. So probably a good trade would be that even for an investor, a good entry point would be he just waits it out, finds when the sector rotation is happening. If he sees more downside on pharma, he buys his favorite name. If he doesn't, if he buys it even 10% higher, it's not going to make a difference for his 2 to 5 years holding. But I think if he wants to take a call and then take an investment position, I would say wait and watch and wait for that 5-10% dip, which you'll find across the sector if the market corrects, because markets have run up quite a bit. And then probably position yourself in the stocks that you like. And also, do a small lot buying. Don't just rush in to buy everything and then, see what's happening. Just keep nibbling your favorite picks right now.
Sure. Sanjay, steel is the other space which, the market is liking right now. And the fact that most are still over-owned or rather under-owned in the name gives you the belief that perhaps there is more headroom in some of the steel names. Is that a story that you like? A couple of upgrades as well coming in, indicating that domestic steel prices are going to be on the uptick for a while to come.
I think so, Aisha. I think steel continues to be a good investment bet. Once again, timing is going to be the issue as to when you want to buy it. Do you buy it when a little bit of a sell-off occurs, or do you buy it now? That's a call one needs to take right now as to what view on the market. But in addition to steel, I think we need to look at 2-3 other themes that will do well over the next few years. I think real estate is one which is kind of warming up now. No one is looking at it. Everyone is underweight. Everyone's reading the headline and saying that real estate is in a bad shape. But quality real estate companies are going to have a good FY 22-23 because inventory buildup has not happened. They're all realizing they need to liquidate and start selling. There is a bit of a demand uptake. And most important thing in these sectors, like you mentioned, steel, real estate, infrastructure, is they're very interest rate sensitive and interest rates are not going up. So cost of capital is not going up. So these are 2-3 places, I think, which should be used to buy in and invest and diversify a portfolio from the pharmaceutical and the IT named if you maybe concentrated in them.
That's quite interesting that you say real estate. Any other contra theme, Sanjay, that you're liking, much like real estate, which is not fancied at all right now?
I think another big theme that's going to play out, and it's kind of sapped me out also and tested my patience, are going to be the PSU stocks. They're all trading 15, 20-year lows, Underlying value is there, but it's kind of tired me also out a lot. But I still feel that government compulsions over the next few years to divest, to get out, and government's clear intent of getting out of places where it should not be, that's non-strategic places, I think that trade will make huge money over the next 2 to 3 years. But like I said, the caveat here is obviously it's tired everyone out, it's tired me out, sitting on M2M losses. But I still believe that the select PSU space will make you humongous money in the next 3 to 5 years. And that's going to be the real India story going ahead in FY 2023.
Sanjay, I dare not call you old, but let me use the word experience and veteran. Now, being a market veteran, you've always been a proponent of value. And to break it simply for our viewers, I've known Sanjay for nearly 25 years. I've admired his ability to pick up value stocks. Sanjay, having said that, right now there is a view in the market that value is not working. Sasta, Sundar, Tikau is no longer what markets are viewing, whether it is NTPC in the power sector or ITC in the FMCG sector or SBI in the banking sector. Do you think we should recognize that?
I think value will work. These are time-tested, metrics that play out. You had, if you go back and see history within Indian markets also, go back and see the mid-cap boom of the, calendar year end FY17, calendar year end 17, as well as the first quarter of FY18. And you saw the way mid-cap themes were running, and they were all trading at 25, 30 multiples. And we said mid-cap is the new manna from heaven. But eventually, everything got hammered out of shape. And people finally started making money in Reliance because there was deep value there when Reliance traded at 900 to 1100 rupees. And now it's 4,500 rupees. So as an investor, you must understand that over time, nothing changes. You have to buy value. Yes, you have to keep in mind growth. You have to keep in mind that you're not just going to buy a sector which from value keeps going into a deep valley, which still has potential, which is relevant to the industry, relevant to the economy, and most important, which we all forget, is globally competitive. We all don't look at global comps when we look at sectors and stocks here because the world is really shrunk in terms of comparing stocks, sectors, etc. When a fund manager sitting in New York managing a few $1 billion, he needs to buy something in EM, he'll always do a global comparison. That's exactly you as a small investor, retail investor, have to do a little bit of work. There's a lot of information available. Is this company or is this sector that I'm buying here going to be competitive? Then it makes sense to buy it. And also, growth is obvious. You can't disconnect value and growth. So you got to understand if you're buying value, is there still potential left in the sector, or the sector is totally gone out of, some destruction has taken place in the model altogether. So we need to be cautious of that. But I still believe in the value theme, and I don't think it will go away.
Buy real estate, Sanjay. Now, there are two types of real estate companies in India. One, you got a name like DLF from your backyard, and then you got a company like Godrej. which one would you prefer? Because DLF will benefit because of operating leverage and balance sheet repair. Godrej is something which will only benefit because of market share gain and because of demand coming back.
I think, Nikunj, I would allocate to both of them because both have different models and both are very well managed. Debt is not an issue with both of them. So frankly, I would be spoiled for choice between the two. So if I were to buy and hold, I would buy both. And in addition to that, there are some other good quality plays also, which have survived this onslaught, which have survived this, severe bear market of 7, 8 years or 9 years in the real estate sector. So I think one needs to allocate money. This is the time. It's just like what Pharma was probably 2 years back and totally, out of shape and no one even looked at it. I think that's where we are in the real estate cycle, particularly in the companies. I can't say about going and buying an individual flat or a plot of land or anything, but I can say about the companies because that's where you get the multiple to asset value and multiple to the earnings. So buy a real estate company instead of going and buying a 20, 30 lakh rupees plot or a flat.
Sure. Sanjay, what about, consumer discretionary within that? Would there be any specific picks that you have? We have seen on the back of demand some unusual picks in the market that have played out. What would be your preferred names?
I think on that sector, I'm neutral at this point of time. It's run up quite a bit. It's expensive. We need to see how much more demand damage there is as far as the consumer is concerned. So I would pause and wait on the sector. I would be neutral weight. I wouldn't be overweight on any, on the sector as a whole or even fancy any stock. So I would have it as a normal allocation, 10, 20% of a portfolio, or nothing more than that. I wouldn't be really overweight there.
Okay. Couple of the other themes that have been incredibly popular, chemicals, agri-commodities, some of these in the mid-cap space where we've actually seen quite a lot of momentum. Would they continue to be, top of your radar? Because the opportunity, of course, continues to be there.
I think the key there is differentiating in those sectors now. See, specialty chemicals and everything under the uncle has gone up right now. So people need to really get down to the granular stuff in all these sectors and pick up stocks. You need to figure out what are the right stocks to play in these sectors. So take a broad call in the sector is very difficult. Sectors are going to do well. They've run up quite a bit. So that's why I'm saying now you've got to get down granular and pick up specific companies. I'm not saying that the sector will not do well anymore. It's overpriced or whatever. But I still think there are opportunities there. But we've got to do a lot of work in them.